Hey guys, thanks so much for joining me today. So welcome to our third quarter 2025 client webinar. Really appreciate you taking the time to tune in. We've got a lot to cover. I apologize for the tardiness of this. Would have gotten this out probably 2 weeks ago, but summer months are crazy. We got vacations and we're looking at colleges for my oldest, so kind of a crazy time. So I apologize, but we'll get through it. Also, I've got the headphones on today, guys. A lot of yard noise, so couldn't deal with it. Anyway, our goal here really is to just give you clear insights on what's happening in the markets and economy, what it can mean for your portfolio, and how we're thinking about it as your financial team. So we've got some market themes here, obviously, that we're going to be breaking down. We've got basically 10 primary slides here. So we're going to be looking at things that we think are shaping markets and the economy this quarter. So it's not only looking back on last quarter a little bit, but also kind of what we see as continuing themes for the third quarter. So we'll start with a look back at last quarter's headlines. We'll take a look at the stock market, which saw a historic rebound in the NASDAQ, and break down what's happening in Washington, tariffs, all that good stuff. We'll look at how the tariffs are actually affecting economic activity, why inflation expectations are up, even though the data isn't showing big changes yet, and interest rates, where they're headed, things like that. Also, dig into corporate earnings and stock valuations, compare some stock and bond income opportunities, and then finish with what we're watching over the next 6 months and long term. So basically, what happened, what's happening now, and what might happen next. So let's jump into it. So we've got our market recap here. So with some Q2 headlines, and the second quarter was full of big swings in the market. Almost all of it tied back to trade policy. We started with Q2 with Liberation Day. That's when the White House announced new global trade tariffs. Um, and the S&P 500 promptly dropped 10%, more than 10% in just 4 trading days. So that was not fun. But by April 9th, things reversed quickly when most reciprocal tariffs were paused, except for China. And the market had one of its best one-day gains in history, up nearly 10%. From there, momentum built, and we had a 9-day winning streak in April. And by mid-May, U.S. and China announced a trade agreement. And so, even with some bumps, like the Moody's downgrading U.S. credit once again, well, it was the S&P last time, but a court ruling tariffs unconstitutional, some geopolitical tensions pushing oil prices higher. The S&P 500 still gained more than 6% for the quarter and closed at an all-time high. So it was a dramatic comeback. So the big picture here is a lot happened, but the market ultimately shook it off and just kept climbing. So let's talk about one of the standouts here, NASDAQ's historic rebound. So this was one of the stories of the second quarter, really. The NASDAQ, which surged 25% from early April to early June. Just a staggering comeback there and return. So kind of unbelievable. That kind of 2 month gain puts it in the top 1% of returns going back 25 years. So it's extremely rare. And historically, we've only seen rebounds like this after big sell-offs. Think dot-com bust in the 90s, 2008 financial crisis, the 2020 pandemic, and so forth. So the lesson here, big declines often set up powerful rebounds, and it's uncomfortable in the moment for sure, but volatility can really create some pretty dramatic opportunities. Okay, let's look at the one of the main drivers of everything this year, which is tariffs. We've got a tariff timeline here. So this year has been all about shifting trade policy, really. In February and March, tariffs increased. China saw a 10% tariff on all goods. Canada and Mexico faced 25% on most goods, and global steel and aluminum imports were hit with 25%. By early April, it escalated further with sweeping tariffs on auto imports and a baseline 10% tariff on most goods. Then just days later, the administration paused reciprocal tariffs for most countries except China. By May, we had an agreement with China, as I stated, that reduced tariffs significantly for 90 days, and a court even ruled some of the tariffs unconstitutional at the end of May. But things aren't settled. Some tariff pauses end in July, which we're in now, and then into August, and so they're fluid, they're evolving, and new actions could certainly still come. If we learn anything, it's that things, they're moving rapidly and evolving quick. For businesses and consumers, this basically means uncertainty and potential cost swings. They're probably not going away anytime real soon. Um, Again, following that theme, so tariffs and economic activity. Tariffs have had a very real short-term impact on economic data. But companies really rushed to import goods before tariffs hit, kind of in preparation for this. So consumer goods and industrial supply imports spiked big time early this year. We saw the same thing with cars. So, vehicle sales jumped in March and April as buyers tried to beat expected price increases from auto tariffs. So these surges make it harder to tell how strong the economy really is because some of that demand is just being pulled forward naturally because of the tariffs. So, the big question is whether that means we'll see a slowdown later this year as the early demand fades. So that remains to be seen. So. Um, Another big theme that's been ongoing for years now is inflation. So what we've got here is inflation expectations versus reality. Tariffs haven't pushed up inflation yet, but the general sentiment is that they will. And consumer surveys from both the Conference Board and the University of Michigan show inflation expectations jumping higher. But the actual CPI data, both headline and core, still shows prices moving lower, not higher. That's the fact. So you got economists that are really divided on this. Some say companies will raise prices as tariffs increase costs, and others say that they'll absorb it. They'll absorb the hit just to stay competitive. So remains to be seen. But that gap between expectations and reality is critical because if consumers expect inflation, they often act in ways that actually create inflation. So and the Fed is watching this closely when deciding, what to do with rates. So. Over to interest rates, another big one, interest rates outlook. So the Fed's balancing act is harder now. Tariffs can mean higher prices, but they also risk slowing growth. And so for now, the Fed has kept rates unchanged, waiting for more clarity. But the futures market expects the first rate cut still in September with a gradual series of cuts through 2026. That could lower rates by around 1.25% over the next 18 months or so. But as we know, that outlook can change fast depending on inflation data and trade developments. So this is why the Fed is kind of in that wait and see mode right now. On to earnings and valuation scenarios here. We've got some earnings forecasts have been trimmed slightly, but still relatively strong, showing growth in 2025, 2026, and 2027. So stock prices, are stocks are priced for earnings growth and a valuation multiple around 22%, which is on the high side. But if earnings beat expectations or tariffs don't hit as hard, the S&P 500 could move higher, potentially into that 6,700 plus range under optimistic scenarios. So, if trade tensions rise again or growth softens, valuation could compress, pushing stocks, lower. But these scenarios aren't predictions. They're ways to think about potential market paths based on earnings and valuations. So, um, stocks versus bond yields. This has been a big one. This has been a big story over the last year or so. So, historically, in some periods, stocks yielded more income than bonds, which is a period that we had been in. But today, now it's the opposite. Bonds currently yield about 4.6%, while the S&P 500 dividend yield is only about 1.6%. This is as of the end of the quarter. But this gap, we have not seen this since the early 2000s, so it's been it's been like 25 years. This means bonds now provide a more attractive income stream than stocks, which hasn't been the case in a long time. Moves like this are good for income investors, especially those looking for, cash alternatives, things like that. So, it can depress current bonds in terms of prices, but the flip side of that is that when you're searching for new issues and things like that, it's definitely a good thing. So that brings us to kind of these key themes that we'll be watching over the next 6 months. We got three big things we're keeping an eye on. So number one, the Fed rate cuts. Will they resume this year and by how much? We've got goods inflation. Will tariffs cause a spike in prices? And if so, is it short term or something bigger? And three is corporate earnings. So will companies absorb costs to stay competitive or pass them on to consumers and risk slowing demand? So these themes, they're all interconnected. Tariffs impact inflation, inflation impacts Fed policy, and of course, both affect growth and earnings. So be keeping a keen eye on that. And finally, economic slowdowns. Yes, it's definitely possible, um, like it is every year. But just remember, they don't last forever, and recessions happen. But historically, they're short compared to periods of expansion. In fact, since the 1940s, expansions have lasted an average of 65 months, while recessions average about 10 months. And so even recent downturns like 2020's COVID recession were sharp but brief compared to the following recoveries. So the takeaway, long-term economic growth far outweighs temporary downturns. So, and this is why staying invested through volatility, it pays off. That's why we do this. Um, and that's it for the themes that we'll be watching, guys. And thanks for joining us. And I really hope this gives you a clearer picture of what's driving markets right now and how we're positioned for it. And for our clients, as always, we're here for your questions or to review your financial or investment plan at any time. And if you're new to us, we'd love to connect and see how we can help you reach your goals. So feel free to reach out to us at any time or schedule a chat with us. We'd love to see if we can help you with your finances as well. Okay, guys, thanks a lot and enjoy the rest of the summer.